Good afternoon, everyone, and welcome to the IRU Apply and TI European Road Freight Rate Benchmark webinar for Q1 2026. Thanks very much for joining us this afternoon. We'll just wait a few moments for panelists for the rest of the attendees to join, and then we'll get started. Okay, it looks like attendee numbers have stabilized now, so we'll get started. So once again, welcome everyone to the IRU Apply, TI and European Road Freight Rate Benchmark webinar for Q1 2026. We're very pleased to have you all with us once again this quarter. And it really has been a big change, I think, in the market conditions since we last ran the webinar in early February. Of course, expectations then for the market were that we'd have a year of steady recovery, really, in terms of the demand side picture for road freight, and therefore a bit of demand side pressure on rates and a fairly benign cost environment. But of course, since the conflict in Iran started, that's all been turned somewhat upside down, and we now obviously have a lot of cost pressure with diesel prices, in many European countries now above €2 per litre, an increase of around sort of 30% in many countries, and no real sign of that changing. So obviously that's going to drive both spot and contract rates up. And we also have the demand side consequences of that crisis in terms of minimizing consumer spending, raising manufacturing costs and output as well, and that obviously dragging on demand for road freight. So in that sense, that's a downside risk to road freight rates putting them down. But with diesel prices and fuel prices rising so much, it's really that's dominating the overall picture. So we're going to go in, I think, in some detail to what's happening in the spot and contract markets. And actually, the Q1 index we'll be talking about today shows divergence with contract rates still climbing and spot rates actually declining in Q1. That's mostly driven by factors in the first couple of months of the year before the Iran conflict started. But obviously, we'll be talking about our outlook and expectations for what's going to happen to rates. Largely, expectations are for them to rise over the rest of the year now, as well. So we'll be diving into all of that today in some detail. A bit of housekeeping before we get started, though. We're expecting the presentation to run for about 35 minutes today. And after the presentation, of course, we'll be sending out the recording and a copy of the report to all attendees, so you'll be able to review it again in your time and obviously read through the analysis in as much detail as you like with that too. We'll also be running a Q&A session at the end, and we have a team on hand to answer as many questions in the Q&A as you have. So please do ask your questions using the Q&A tool on Zoom, but we'll also answer some live at the end. And of course, we'll also have our poll towards the end of the session today, so please be ready to answer that. We'll be asking you for your views on what's going to happen to freight rates over the next quarter as well. All right. So once again, welcome everybody to the webinar. Let's also now introduce our panelists. So I should introduce myself first. I'm Michael Clover. I'm TI's Head of Commercial Development, and I'm your host for today. For those people that don't know TI as an organization, we are a provider of logistics market intelligence for road freight, but across the whole freight, air and ocean freight industry and contract logistics as well. So for any strategic questions on the industry, we're here to help. I'm also joined from TI by my colleague Janan Hassan as well, who's one of our analysts and works on the data for the report, as well as a lot of the analysis of the rates that you'll read in the report too. So welcome, Janan.
Hi, everybody. Thank you, Michael.
Thanks, Janan. In addition, we also have Romain Mouton, who's a Senior Research Manager at IRU. Welcome, Romain. Would you care to introduce IRU for anyone who doesn't know the organization yet?
Yeah, good afternoon, Michael. Good afternoon, everyone. So if you are unfamiliar with us, the IRU is an international organization of road transport. We are based in Geneva, and really our mission is to give voice to transport operators and to support them in becoming more sustainable, more efficient, and safer on the road. Looking forward for this webinar, Michael, and pleased to be with you today.
Thanks, Romain. And before I introduce our last panelist, I must just read a little disclaimer here. We remind you that all discussions and statements made by participants on commercially or strategically sensitive information may fall within the scope of competition law and be considered as unlawful. We invite you to refrain from sharing any information of such nature or entering into any such discussion, including during breaks. And finally, I can introduce our last panelist. It's Thomas Leroux, Chief Executive Officer of Apply. Welcome, Thomas. Nice to have you with us once again today. And could you introduce Apply for anyone who doesn't know the organization yet as well?
Yeah, thank you, Michael, and hello, everybody. Upply is a European tech company dedicated to supply chain and logistics. So we are very good in handling a lot of data, transport data that are very complex to manipulate and to take value from it. This is what we do for almost 8 years now. And we have many different services, applicatives, let's say bricks or modules to manage road transportation, for instance, in spot or contract, and also to get data from the market. And this is exactly what we will do today. It's take transactional data, real invoices that we collect at Apply on a daily basis, and use it to provide insights and for shippers, for instance, to manage their quotation, their RFQ, for freight forwarders also to make automated quotation or dynamic pricing. This is the data that we will look at today and that I will introduce just after.
Thank you, Thomas. Okay, and our first slide today will be just a quick look at the methodology behind this report, and particularly looking at the freight rate data. So Thomas is going to just talk us through that, just to answer some of the, I guess, FAQs that often have about the data here, but it's also an opportunity for us to talk about a change we'll be making to the data set and transitioning to a new index for next quarter. So could you just take us through that, Thomas?
Yes, and you're right that this slide, that the objective of this slide was really at the beginning to try to answer as many questions as possible, the one that we usually have during the webinar. But please, if you have others, feel free to ask directly in the Q&A space. We will use today road transportation data, FTL, so full truckload. We have additional data for LTL or others, but today it's focused on FTL, general cargo, spot and contractual prices. And the fuel will be included in the majority of the index. Sometimes it will not, and this will be specified. So this is the data, the raw data that we use today, the data that we have been using for several quarters now. And we are pleased to announce that in the following weeks, we will launch what we call Smart 2.0. That is our new algorithms with much more data, multiplied by two or three across all Europe, that will give very accurate benchmarks in many countries, where today the coverage that you see on the left of the slides, where the darker is the blue, the more coverage we have. We will add more and more coverage in these countries, but also in the lighter one. And this was really the target, to have the best indicator regarding freight rates. And this is what we will see in the following slides, the evolution of the freights directly for FTL transport from real invoices.
Brilliant. Thank you very much, Thomas. All right, well, we'll move on to our analysis now. And first of all, as always, we'll look at the overall European picture here in our aggregate index, which is assessing spot and contract rate development separately. And as you see here, there's been a bit of a divergence this quarter, with contract rates continuing to climb, spot rates actually falling. Janan, could you take us through the trend here and what's driving it, please?
Of course. Thank you, Michael. So the benchmark index takes contract and spot rates and bases them to Q1 2017. And what we're seeing in Q1 this year, like you said, is that divergence between contract and spot indices has actually widened. Contract is at around 140 index points, and that's about 3 points up versus last quarter and 9 points versus last year. And that's driven by previously sustained demand for contracted volumes at higher levels. Spot rates, on the other hand, are down to 132 index points, falling around 3 points versus last quarter and ending the period 2 points lower versus last year. So the upward momentum we're seeing through mid-2025 has stalled on the spot side. So what's driving the contract side? Manufacturing is a big part of the story. The Eurozone PMI reached 51.6 in March, and that was the strongest reading since June 2022, with new orders expanding at their fastest rate in 46 months. That kind of industrial activity pushes businesses to lock in contracted capacity. And on spot, the picture is more about consumers staying cautious. So the Eurozone savings rate fell to 14.4% to close 2025, but income growth is only running at 0.8% versus last quarter, and inflation is eating into that buffer already. So consumers haven't really loosened their purse strings enough to push spot rates and demand higher. And then, of course, everything changed towards the end of last quarter. EU diesel prices have surged 26% between the end of Q4 and the end of Q1, driven by the closure of the Strait of Hormuz, pushing crude oil prices above $100 a barrel. Operators simply cannot fully absorb the cost increases of that scale, and they would have to be passed on to rates. So the outlook for Q2 is that rates increases will predominantly be cost-driven rather than demand-driven, and upward pressure on both spot and contract rates is expected to persist through at least H1 this year.
Yes, thanks, Jan. So, quite a change really, and we'll be discussing outlook a bit further as we go through the presentation. But that's the overall picture, but we obviously need to also look into the supply and demand side factors. And we're going to go through some really interesting data from IRU to help show that. So, Romain, could you just take us through this first chart on macroeconomic drivers, please?
Yes, Michael. And on volume development, we are tracking road freight in tons kilometers. And starting with tonnage, road trade between major European economies fell 8% in Q1 year on year. While retail and industrial activity remained stable, construction fell by 3% and extra EU trade dropped by 10%. However, and this matters, lower tonnage doesn't automatically mean lower freight volumes, given in tons kilometers. Longer truck journeys, like trips from East to West Europe, partially compensate, so the story is more nuanced than the headline decline suggests. Looking at the outlook, 2025 was a growth year, but 2026 faces headwinds. Energy prices and inflation are the two critical drivers for road transport, and both point towards softer than previously forecasted volumes. And based on February data, the 2026 IRU forecast suggests 1.3% growth compared with 2025, assuming that the Brent averages $89 US per barrel this year, and that the EU GDP growth reaches 0.9%. Consumer spending is still rising, which supports our freight volumes growth, but our forecast depends on how long the current pressures persist, including fuel availability, fuel prices, and inflation. And on inflation, inflation itself is tightening. Eurostat shows EU inflation rose from 2.1% in February to 2.8% in March. And for the Eurozone, it rose from 1.9% in February to 3% in April. There is also some positive news. Recent trade deals with Australia, India, and Mercosur should lift imports and exports in the coming months. But the US tariff remains a concern. Freight corridors serving US-bound goods faces direct exposure to demand shift. So we are at an interesting moment, Michael, where opposite forces apply on volume development, and we still don't know for sure which one will prevail.
Yes, it's a very interesting picture, isn't it? To try and examine there, but it's always good to try and see if we can project forward what's going to happen there, even when it's as challenging as it is at the moment. All right, so that's the demand side picture, but on the supply side, we'll take you through a few key changes here. And obviously, we talked about the biggest story probably is the diesel prices, and this chart shows that, I think. But will you just take us through the change we've seen and any expectations you have, Romain?
Yes, and as you said, this is a big story of Q1. And as a reminder, like the Brent started this year at $60 US per barrel, its lowest value since the COVID-19 pandemic. It's, however, now trading above $110. The closure of the Strait of Hormuz, attacks on shipping and damages to Middle Eastern production sites drastically reduced global crude and refined diesel output. In March alone, global oil supply fell by 10%. Floating storage and existing surplus helped partially absorb the shock, but uncertainty about the war's duration and ceasefire status makes forecasting difficult. For carriers, the EU diesel prices rose from 1.56 euro per liter at the end of Q4 to 1.96 euro per liter by the end of Q1, a 26% increase in just 3 months. France and Germany drove the average higher, with increases of 27 and 35% respectively. During that time, governments reacted quite quickly, but not in a uniform manner. Some of them capped diesel prices, such as in Slovenia and Croatia. Others cut extra duties, such as in Ireland or Italy, or reduced VAT rates, such as in Spain. And these fragmented responses created price discrepancies of up to €1 per liter between countries, triggering fuel tourism and straining supply in cheaper countries. As a result, some of them, such as Slovenia and Slovakia, then introduced rationing, and Hungary capped prices only for Hungarian vehicles in a measure to protect local supply. Earlier cash reserves have been wiped out in the meantime due to this price increase. Only Spain, France, and partly Italy have official fuel indexes that allow carriers to pass costs through, but this indexation mechanism were not updated fast enough. And Spanish hauliers struggled despite the law until the government issued a new decree in March that strengthened pass-through rights, updated the formula, and imposes penalties for non-compliance. And looking ahead to Q2, prices are still climbing, so at different rates depending on national measures. The EU average for April is already 10% higher than March, but stabilizing in this beginning of May thanks to the new German measure on excise duties. Question also arise about diesel and AdBlue availability, notably if the crisis continue in the summer months. Today, air transport is struggling to secure jet fuel for the summer months, and EU refineries may want to produce more jet fuel at the expense of diesel production. As for AdBlue, this mandatory depurating product for trucks is made from urea, mostly imported from the Middle East in Europe, and if the crisis continue, it could put supply at risk. AdBlue prices are already rising, but the impact on TCO should be minimal. However, the reduction of AdBlue supply would pose a major threat to available transport capacity if there is an issue of availability of AdBlue. And I will end, Michael, on HVO prices. They continue to climb in Q1 across most EU countries, notably Belgium, Denmark, and Sweden, where the fuel is quite popular among transport operators. With the rollout of RED 3 and HVO trains broadly tracking diesel train, we see that between December and March, HVO prices rose by 30%, therefore remaining more expensive than diesel and closing at an average of €2.5 per liter in March.
Yeah, so it's a very interesting situation, isn't it? So I think that point about AdBlue there is also another really interesting, perhaps less read about or focused on point as well with fuel prices. So we keep watching that space, but with the current developments in the crisis in the Middle East, it doesn't look as if there's going to be any relief from that anytime soon. We also wanted to highlight another area of cost development here on tolls. So remains. Could you take us through what's happening with tolls as well, please?
Yes, on tolling, we saw some regular increases in the EU, typically taking effect in January and February. The largest increase was in Poland, where tolls for a standard Euro 6 tractor semi-trailer combination rose by 33% in February, which followed a previous January increase. So the year-on-year change is about 40%. Another toll increase, but through the network. The tolling network also expanded by about 650 kilometers, a 12% increase in length. Other country to raise toll rates in February was France by 86% on average, with a maximum increase of 1.4 on the coffee route network. A little update on Hungary. Hungary was planning a price hike of around 30% in March, the second increase for 2026 after a 4% increase in January. But the March increase was cancelled too in a measure to support transport operators. So nothing planned in Hungary for 2026. In the outlook, the next relevant increase is planned for July in the Netherlands, which will move from a distance-based from a time-based, to a distance-based scheme, as Denmark did in 2025. And the good news, Michael, is that the toll rates published at the beginning of 2026 are expected to be reduced following a vote on the 23rd of April, but the size of reduction is not yet known. So we will have certainly more information in the coming weeks.
Okay, well, that's at least a little bit of perhaps better news from a cost point of view for road freight operations there. So that's good to hear. So the next slide's looking more on the capacity situation, really, but looking at truck registrations and what's going on with the overall goods fleet in Europe as well. So again, Romain, if you could take us through this one, that would be great.
Yeah. So here we are looking at the ACEA truck registration data for 2025. Fleet renewal was slowing last year. New truck registration declined by 6% last year compared with 2024. Limited investment in fleet modernization could lead to future capacity constraints, particularly as most vehicles continue to rely on diesel. Latest data for Q1 2026, which was released by ACEA like a few days ago, is showing that the storyline might be different from last year, as registration increased by 10% in Q1 year-on-year, supported by strong sales in Poland and in Spain, and compensating partly a rough 2025 year for Spanish registration number. Adoption of zero-emission technologies, namely battery electric trucks, remain fragmented and quite slow, likely reflecting concern about enabling condition, limited investment capacity, and uncertainty around the evolving regulatory framework. Electric trucks secure 4.4% of market share in Q1, supported by a strong increase in Germany and in France. A comment, although new registration provide insight into vehicle capacity trends, this figure must be contextualized against the 6 million trucks already operational in the EU market. So let us see at the next webinar, Michael, if the registration dynamic of Q1 continue in Q2.
Yes, yeah, indeed. Okay, well, that's very interesting. So I think we then have to think about how all these different factors meld together into the supply and demand mix, and obviously, how does that all play out? And that's the challenge we have with freight rate expectations now for the next few quarters. But we're going to dive into the next stage of analysis now, which is to really look at the domestic rates in Europe. And we're going to start off with contract rates here to take a look at developments across 4 key countries. And Thomas is just going to highlight a few key takeaways from what's been going on with contract rates across Europe over the last quarter.
Yes, Michael. What we can see over there is it's domestic contract rates. So when we look at it from a statistical perspective, it's really linked with the GDP and the global demand that we have in each country. If we will compare it after with the international one. But here, what we can see quite clearly is that some countries like Spain, for instance, and Italy also. Let's take with Spain, that is a kind of orange color in the graph. It's going quite well over the past months. Very well if we look really at the end of 2025, mainly with the global demand, the fact that Spain, once again, I think we are saying that for almost, we are saying that for almost several quarters now, but Spain is really the good students of Europe right now, and we can see that directly in the domestic contract rates over there. It's a bit the same for Italy, a bit more bumpy here in the slide, mainly linked with the data. We can have a look at a linear, let's say, increase without the up and down. while Germany had a higher level and then go back and it's quite stable. For France, it's almost the same. Also, if we're looking at the outlook for these specific countries, with what is happening, and this is, I mean, if we're looking at beginning of January 2026, the outlooks for Germany, for instance, was a kind of recovery with a GDP around 1%, 0.9%. With the fuel that is now at the level that we know, the more, I mean, days and after days, the GDP increase for the year of 2026 are cuts. We are, I think, at 0.5% for Germany right now. And the more the fuel is at this specific, or the oil is at this specific price, the harder will be the impact. And this is really the big question right now, where for carriers and freight forwarders, they have a direct impact on their costs with the fuel, but with also additional costs that increase, and we'll see that later. And on the other side, we might have a shortage of demand because of lower GDP increase, lower manufacturing production and demand. And this is really the key part of the quarter to come, because just to end on that part, the impact of the fuel on the quarter, and here we are finishing at the March, we see February and there is the last one of March. We don't see the impact of the fuel increase on March yet on domestic contract, because usually you have a kind of 2 to 4 weeks delay between when you are backed on a fuel index. You have this delay of about 3 to 4 weeks. So we are starting to see the huge surge that happened at the beginning of March in the data of April right now, and clearly in the data that we have at Upply, we see the increase in April. We will see it even more in May, and this delay will need to be taken into account.
Yeah, that's really interesting. Look at that lag on the impact from contracts, and I suppose a slightly different story for the spot rates, which is our next slide. So there we see obviously a much lower latency or a higher degree of responsiveness to cost changes. So Janine, can you take us through the more volatile picture we see here?
Of course. So what's happening with domestic spot rates this quarter is really quite a contrast depending on which market you're looking at. Spain is the obvious standout. Spot rates have reached 155.6 index points in March, and that's up around 7 points versus last quarter and 14 points versus last year. And we can see that reflected in the Spanish economy. GDP grew almost 3% last year, and that's almost double the Eurozone average. Private consumption and investment have increased, and that momentum carried right through into Q1. And on top of increased demand, diesel prices in Madrid jumped 36% across the quarter. So rates are being pushed up from both sides, demand pulling from above and rising operator costs pushing from below. Germany stands at 129 index points, up around 4 points monthly in March, but essentially flat versus last quarter and still down 7 points versus last year. The recent monthly uptick is an early sign that volumes may be beginning to recover. Italy is at 108 index points, and that's up slightly monthly, but still down 7 points versus last quarter. And while there were some bright spots for growth in Italy, the economic backdrop in general remained under pressure, particularly given Italy's heavy reliance on gas, which does account for around 40% of its energy supply. And that has made it especially exposed to the Middle East war. That said, Italy's manufacturing PMI did reach 51 points in March, and that was the highest reading for 37 months. So there are early signs of recovery. France closed March at 123 index points, and that was down almost 6 points versus last quarter and last year. The European Commission forecasts French GDP growth at just shy of 1% this year, with domestic demand continuing to be weighed down by economic uncertainty, and that is a limiting factor for volume demand needed to push spot rates higher. Looking ahead, Spanish spot rates should continue their upwards trajectory supported by domestic demand and GDP growth, although the rate of growth that is supported mainly by demand may moderate in comparison to last year as the economy gradually cools. As for Italy and France, diesel costs will likely be a primary upward driver in Q2 rather than volume demand, which does remain subdued in both countries.
Thank you, Janan. Yes. So, expecting to see diesel taking a bigger part in increasing those rates in the coming months. So that's spot rates. Obviously, really interesting dynamics there, but we'll also look at the situation with international lanes as well. And again, we'll start with contract rates here on a few key lanes. And Thomas, could you just highlight some key takeaways from this data?
Yes, here we have international lanes are quite interesting because you see different impacts that are mixed together, and you need to have an European view, let's say, or outlook of all these lanes. For that, we like at Apply to have a look at it regarding the demand, the offer, and the cost structure also. And in the reports that you will receive after the webinar, we have a full paragraph on the cost, and I will just quote some line that we have is that on different in average in Europe over the two past years, the cost inflation was about for the fuel and for other costs for road transportation was about 7.7% increase. You have a huge increase over the past year, only of 2.4% linked to driver personnel, maintenance costs, insurance, all the things that we see even more here on international lanes because it's merged with all the European countries. And what I wanted to say also on this specific graph, because we see here some big increase between Warsaw to Duisburg or also Paris to Birmingham, for instance. We have in certain countries, and this is true for the Q1, I will take two examples. The first one in Germany. Germany started the year quite well. They started the year with a PMI index, so a purchasing manager index that was revised upward at a good level. This was the case at the beginning of the year, and the fuel crisis that we see today is not good things and have a negative impact on that. And we see the last figures that just pop up. That was updated over the past days that shows indeed, and this is what we are all seeing here, that these good figures that we had at the beginning of the year and the Q4 2025 are not realistic anymore, for the rest of 2026. The other things that was quite positive, and this is something because we need also to be optimistic and positive. In Europe, there is the big increase is linked with the information and communication technology, the ICT equipment, where we have a very strong industrial request for that in France, in Italy, in Spain, where you have a lot of a need to build data warehouse, to invest in AI. And we see that directly in the Eurostat data at the beginning of the year. And we know that this needs logistics, this needs transportation, and we see that also in the data. So for sure, there are many other industries, but this was just to highlight some good points that we see here. And if we deep dive on the different index that you see over there, what we do on the report, you have explanation on why a strong growth with Poland, with Spain again, with certain countries that perform quite well in terms of GDP in Europe, even in the current conditions.
Thank you, Thomas. Yes, there's some good news stories underlying the overall picture there. So it's nice to highlight those. And, the demand picture is actually not as still relatively strong. So that's not all change. Okay, we'll now also look at the spot side of the international market, and Janan's going to just explain some of the key developments here.
Thank you, Michael. On the international lanes, Q1 brought a fairly mixed picture depending on the route. Spot rates on Madrid to Paris have partially bounced back from a soft Q4, and the index was up 5 points versus last quarter and 1.6 points above last year's levels. However, manufacturing PMI dropped to 49.6 at the very end of the quarter, and that was the first contraction since April of last year. So that recovery may be bumpy going into Q2 in Spain. Warsaw to Duisburg rates declined by about 6 points versus last quarter and versus last year, coming off a particularly strong Q4. Poland's manufacturing PMI did improve slightly in March, and the output grew for the first time since April of last year. But new orders have fallen for 12 months, so volumes are still constrained on that route. Duisburg to Liel fell by 10 points versus last quarter, following a notably busy Q4, and the index is also 8 points lower year on year. Paris to Birmingham is up 7 points versus last quarter and almost up a very impressive 13 points versus last year. Cross-channel import demand is driving this, with EU imports into the UK up 2.3% month on month just this February. Chemicals and machinery are leading the charge, and France is a key and growing origin for both. And on top of that, non-fuel CNR long-haul cost index has edged up every month throughout Q1, and so costs are pushing from below to, as Thomas has mentioned. Finally, Madrid to Duisburg is up 16.3 points versus last quarter, and that was following a decline in Q4, although it remains 6.6 points above Q1 last year. So looking ahead, the key variable across all lanes is fuel. As Romain pointed out, the EU average diesel prices rose 31% in March alone, and that cost pass-through will keep upward pressure on international rates through Q2, regardless of the demand picture. On the volume side of things, EU export market growth is expected to slightly slow under the weight of global tariffs, like Romain mentioned earlier, but there are some bright spots for growth as well. But rates are more likely to move upward, led by costs rather than volumes, which caps how far they can rise.
Thanks, Janan. Yes, so those increases still expected, though. All right, so the next part of our presentation today will be focused on our sentiment index, really. So we're going to be running our poll to ask you what you think is likely to happen for rates. So you should see that now popping up on your screen. If you could give your view, that would be much appreciated. Now, just while you're doing that, I'll just take you through the results from the last quarter, but you can see the chart here indicating, obviously, sentiment increasing. Actually, it rose by 6.2 points for Q1 versus Q4 2025. So that indicates an increase in expectations for rates to tick up. But it's worth bearing in mind that's really before the Iran conflict came into the equation, and obviously the impact that that's subsequently had on fuel prices and of course on demand as well. So be really interesting to see your results now. So see a few people voting. So just hold on before we share those results. Yeah. All right. We'll end the poll now and I'll share the results with you. Not really very surprising though. You can see the vast majority of people there, 86% suggesting that rates will increase to some degree, which I think is probably in line with what we've been talking about in our own expectations. But Thomas, do you have any comments on that?
Yes, the first one is that it's been almost 3 years now that we are doing this kind of sentiment index. We backtrack it, and it seems to be at first, to be honest, we thought that it was a cool, good tool to try to get the mood of the market, let's say, because you're about 500, I think, to answer to that. So it's quite a statistical significant number from a statistical perspective. And we figure out with the backtracking that was quite robust in terms of contractual prices. So it feels that the sentiments that the people have is less linked with the spots that we see at a specific moment, but more with the contractual one. And so the quite mid-long term view. We have seen that in the Q1 2026 because the increase was indeed in many countries for the contract one. And what we see here, so it's not surprising with the current situation and with the inflation that we see regarding the fuel. So the huge majority, about more than 86% that think that it will increase or substantially increase. And my view on that will be linked once again with offer and demand. Clearly, we'll have a cost pressure with increase of fuel, increase or other costs, because we know that the tires, for instance, is linked with the fuel, and we have seen that also with the Ukraine war. We are in the same case, almost the same case, with the same level of fuel, and we have seen the impact of on costs. So it will be very likely that it happen like that. The demand, it's always the same. If the demand is not here to absorb all the costs, the costs pass on to the shippers will not be full, and it will have an impact also on the profitability of carriers. If the demand is here, it will increase even more the prices, the rates. And this is one question that we had also in the chat. We decided here in the webinar to not post data regarding the bankruptcies. We have talked also, I know that many people here around the table are publishing this kind of data, and it has, in 2025, it was a bad year for carriers and freight forwarders with, and especially at the end of the year, with a lot of bankruptcies, and this also has an impact on the offers, the current offers on the market.
Yes, it's another measure of sentiment. It's a hard one in many respects, but they're really interesting to see the analysis how it tracks against contract rates as well. Thomas there. All right, so that brings us to the end of our presentation section. But I see we've had lots of questions as usual today, so we'll try and deal with a few more live as well. So we'll start with the first question here. Is perhaps I see one for Romain, I think. Could you please comment about the recent mandatory fuel surcharge mechanism based on diesel price variation to be applied in Spain? And Romain, if you have to answer that question.
Yes, sure. So starting from 2022, Spain voted a decree where there is an automatic price revision based on diesel price variation, which was becoming mandatory. But the effect of the current crisis shows the limit of the system, and the government decided to reinforce it with the new decree. And the new decree is in substance saying that the automatic price revision is now explicitly mandatory, and there is no derogation possible. Like any contract clause attempting to waive, to delay it, or to contradict will be null and void by the law. And the decree is also saying that for continuing contract, the revision applies automatically in every billing period, regardless of the magnitude of the fuel price variation. So the prior 5% trigger is no longer on. Invoices also must now be separate, or it should be like separately itemized. You should see on the bill a fuel price variation adjustment. And another thing that mentioned the decree is like the support that Spain is putting to transport operators, the 20 cents euro per liter professional diesel rebate cannot be netted off of the base price when calculated the revision. So it's a bunch of measure reinforcing the 2022 text, joined by other measure looking at sanction for non-compliance. And the sanction will be or have been hardened by the Spanish government.
Thanks, Romain. We've also had a few questions about, isn't the contract increase expected, or just a result of fuel price surcharges? And I think it's just worth saying, well, yes, I mean, we do include fuel prices, fuel surcharges within the rates here, so that is obviously shown. And I think we're explaining that with fuel price increases are a big factor in the increasing rates there. So yes, you're right. Those of you who've mentioned surcharges there. That is a key factor there. Okay, we've also had another question here. This is maybe an interesting one, looking at sectors. As Thomas, you were talking about some sectors of brighter demand. Perhaps automotive isn't one of them, but here's a question on automotive anyway. Can you let us know your experience and view related to the automotive market in Europe? What is the trend, and how do you see it, the stress over it compared with other industries like retail or agricultural? So Thomas, I don't know if you could share your view on that.
Yeah, the industry view, I mean, industry by industry is quite interesting, because for sure you have different story for each industry. And regarding the automotive, and this is linked also with what we see regarding what we call the nearshoring belt. So the fact that we are sourcing more and more close to Europe, and mainly close to from Morocco or from North Africa countries, and also from Poland, from Romania, and these different countries, and Turkey also regarding automotive. The main figures that we see is that the automotive sector was going quite well at the end of the year and beginning of the year, but we don't have the latest figures with the impact of the fuel market. Will it have an impact directly on all the market, or will it boost the electrical market, which is also a point and a question that is quite fair to ask. So we see so regarding the automotive market, it's linked also with the good shape of economic shape of Spain. And we need to see what is the impact of the current situation on this specific market, because you have companies that are quite well off, and you have, on the other hand, some that are in the stock market not in a good shape at all. So need to have a look right now to see that in more detail.
Thanks, Thomas. Yeah. Okay, next question. We've had a question here on the TI road freight forecasts for 2026, and whether or not we think the current factors are likely to change that. So I'll just deal with that one. Yes, I mean, that obviously forecast was published last in early December, and that's before the latest round of disruption took place. So we do expect what's currently going on to have a downside impact on our forecast, but we'll be releasing the latest figures for that in June, which should give you an update. But the expectation is that demand will be slightly tempered by what's going on, but it still will, be a reasonably good demand picture there, but obviously you have to wait for the full forecast to be released as well. Okay, next question. Perhaps one for Janan here. What are the expectations starting from September in terms of volumes and prices? I think contract will remain steady, but spot ones will reduce in front of volume reductions. Volume reduction produced by those high energy costs that normally provoke a reduction of industrial output. What is your view? Janan, would you like to tackle that one?
Of course. So from September onwards, I would expect volumes to soften further. The energy shock we're seeing now typically feeds with a lag. So by Q3, you will start to see weaker industrial output and more cautious ordering patterns. We already have seen input costs rise, and that's according to the latest PMI data. And that is putting pressure on manufacturing margins and pushing factory gate prices higher. So that squeeze on producers is already building. On rates, contracts should hold relatively stable. Those arrangements were locked in during a stronger demand phase and will tend to adjust a bit more slowly. Spot is where we'll see most of this adjustment happen. With weaker volumes and less urgency, spot rates should ease, but the downside is limited because elevated fuel and operating costs still act as a floor.
Yeah, thank you, Janan. Um, and then another question for Thomas here. Do you have a national picture for Italy compared to other peers or southeastern European countries? Thomas, would you like to tackle that one?
Yes, we do. We just needed to select some countries and pairs, city pairs for this webinar. But keep in mind that we have data across Europe. So if you need to have data for a specific country or for a specific pair of countries, this is data that we can provide at Upply directly. You can contact me directly or contact Upply through our website, and you will have access to this data directly.
Thanks, Thomas. Yeah, there's a couple of other similar questions across Europe for availability of data, but I think broadly the same answer, whether it's Italy or Germany or wherever, really. Okay. All right. Yes, there's a couple of questions on the same kind of lines as well, actually. Um, yeah, so there's a very general question here about what are our expectations for road freight development over the next couple of years. Well, I think in terms of what we've spoken about in the short term, we're looking at rate development being, quite high. In terms of volume development, we've spoken a little bit about the forecast. IRU shared their views, and I've mentioned a little bit about TI's expectations for volume development as well. I think maybe one other thing to consider that is we're throwing into the mix just on rates themselves is when we look at our poll, we're expecting rates to increase. We're obviously looking at being driven by diesel prices, and we see them already up 30% around that €2 mark. So one question may be how much higher can they go, and actually do we think we've sort of hit the peak of those, or not? And maybe they will rise a little bit higher. There's also the possibility that they won't rise too much more, and that actually there may be a regression to the mean over the course of the next year ahead. That's hard to envisage at the moment as prices and fuel prices particularly keep rising, but is also a consideration that we may be at something like the plateau in rates too, and maybe the 4% of people talking about rates declining may have had that in mind, that we may be around the peak already. With rates, it's just the big question there, of course, is is that true? But also, how long will this situation remain? So,
Yes, and
some of my
Michael,
thoughts, Thomas. Yeah, go ahead.
yeah, no, and if I can also, there is one thing that we didn't mention here, but I guess we will mention it in forthcoming webinars, is the ETS2 that will happen. So hopefully not in 2027, but in 2028 now. That will have also directly an impact on the euro per kilometer. That will uprise everything. And that is already a question that many shippers and freight forwarders are asking, to see if they can readjust their supply chain, make maybe smaller loop, or try to reduce the empty part of the trucks. So this is also something that will have an impact, a positive impact in the sense of higher rates. I don't know if this is positive or negative, mainly negative, but an increase of rates. So yes, for the forthcoming years, offer and demand will be key, because if the demand is not here, it's difficult to have prices that are increasing. But it's quite clear that the costs, whatever happen, will increase quite sharply for road transportation, fuel, gasoil or road transportation. Let's see what happen in terms of other energy or multimodality also.
If I can add my 2 cents as well, let us not forget Euro 7 coming in the mid will increase the price of vehicles. We are seeing already like the new US regulation might increase the price of truck by 10% in 2027. So let's see what happened in Europe, but maybe on a more positive side, when you look at the fuel intensity of 1 ton kilometer there is room for improvement. On average in Europe, if I take the analogy with a truck on a highway, we are consuming 100 liter per 100 kilometer on average, while a truck is capable of doing much more. So if we can reduce empty miles, shorter the range and the route, and have a more efficient logistics, I think we can compensate our energy price increase.
Brilliant. Well, thanks very much, everyone, for sharing your views. And thanks, everyone, for attending the webinar today. We're always pleased to have so many of you joining us for the discussion on rates. And obviously, we'll watch with great interest what's happening in the markets between now and the next report and webinar. Obviously, if you do need more information in the meantime, then please do get in touch with TI, Apply, or the IRU, depending on what kind of data you need, because of course we all cover this all the time, not just once a quarter, and can provide you with much more current data as well. So thanks very much to my panelists again, and thanks everyone for joining us. We'll see you next time. Bye-bye.
Thank you.